something that's a little deeper than a lot of people think about insurance. But folks, I think it's the truth. We're going to talk about effects of effects, or perverse incentives. I'm going to tell you a story that was told to me by my recently deceased professor of finance in college, Scotty Hendricks, Kansas State University. Scotty told me about a case study. And in that case study, he talked about a company that was on the brink of bankruptcy. They had millions of dollars in debt, and they had around 50 grand left to actually meet their nut. Now, what do you think the executives of the company went out and did? Well, they did something that was exceedingly stupid, but also hyper-rational because of the incentive structure around their situation. Any other situation, this would be seen as stupid. They went out and they spent tens of thousands of dollars on lottery tickets. Think about that. This is a company worth millions of dollars and millions of dollars in debt. Spent tens of thousands of dollars on lottery tickets. Now, why? Well, I don't know about the legality. Well, the reason why they did that is that they knew that there was no way for them to make up the shortfall they had, with the exception of chance. So they went and bet big, and they lost it all. But to them, what was the difference of a loss of $10 million or $9,950,000? Still a complete loss. So different situations become different logical outcomes. That is called perverse incentives. And they exist in the insurance space as well. Whenever we have members who pick up insurance, their actions change. Just like when people own a car, they start making different choices about where they work because they're more free to do so. When people have insurance, they make different choices. This is called perverse incentives. And as we talk about insurance, we need to know more than just the baseline. We need to go deeper. This is one of the terms that you'll see over and over again in our space, perverse incentives. Everything has an effect on everything else. So, although we are all individuals, we are all also members of society. And that interplay is where insurance exists. We are both individuals and a member of the collective. And as such, we need to get the incentives right to get the systems right. If you don't have the right incentives, it doesn't matter what you do. You're going to have bad results. Or at least over time, your results are going to become more and more poor. So how do we align the incentives in insurance? This is where mutuals come from. This is where level funding comes from. How do you align the incentives so that the people win when they are prudent? And how do we get rid of the systems where the people have no difference whether they're prudent or not? If we only punish the prudent, or if we do not reward the prudent, then we only punish them. And we get costs in this country that skyrocket, which is why we've had them for so long. Double-digit inflation currently in the medical space. My name's Tom. I know this is a nerdy video, and we're talking about level funding here at ATA. But if you love insurance and you'd love to help use the philosophies of incentives to help your clients win, let us know. We can talk about it and see if we can help you. See you out there.